The stock market provides people with a number of investment options. It is possible to buy, sell, or trade stocks in order to own shares of public companies. Prices for stocks are based on company earnings. In general, if the company has a lot of money invested in it, or if it's predicted to do well in the future, then its stock prices will likely go up. Stocks are also an investment, as well as a form of equity. When the company can afford higher dividends, shareholders will receive these dividend payments. Investors buy stocks with the expectation that they'll sell them later at a higher cost, while sellers want to do the opposite. Traders will bid at a cheaper cost if they feel the company is not going to perform well, and bid for a higher cost if they like how the business is going. Understanding the stock market doesn't have to be complicated. We will explore what the stock market is, how it works, and how you can invest in it. So if you want to know more about this, then this video is for you. For today's video, exclusive for Fortune Fastlane members, we will be talking more about how the stock market really works. From its humble beginnings in Western Europe markets, the stock market has grown to be a vast and widely explored force. Here's what you need to know about it from a historical perspective. A stock exchange or stock market is a place where public companies trade shares. The price of these shares is determined by market supply and demand, which can be impacted by investor purchase decisions. When people demand a share, the price of the share increases. When demand is low, which leads to fewer people wanting to be invested in a certain stock, then the price of the share decreases. Stock markets first appeared in 17th century Amsterdam. The stock market is a way for people to buy and sell company shares, also known as stocks. The definition of the term usually refers to major indexes, such as the S&P 500 or Dow Jones Industrial Average, to track a company's stocks. This makes it easier to track stocks since it's hard to keep tabs on every single one. The stock market exchange will include the most significant or most popular companies. The performance of those companies is usually representative of how well the whole stock market is doing. When the market closes up, it means that stocks within the index traded higher than they did in the past, which means the market gained value as a whole. When the market closes down, it means that investors could lose money because the stock indexes fell in value, which means the market lost value. The stock market is not determined by the American economy. Rather, the US economy can affect it, and it has a potential to contribute to it as well. The stock market operates much like an auction, with buyers and sellers negotiating prices for stocks. The last buyer pays the most for the stock, so it is important to know when stocks will be traded and who is trading them. When a company goes public, its shares of stock can be bought and sold through the stock market. The Nasdaq or NYSE are basically platforms that companies list their stocks on after undergoing an initial public offering. Investors buy shares of stock from the company and use that money to grow the company's business. The exchange then tracks the supply and demand for companies and shares of stock through a process called trading. One way a stock exchange can work is where the bidders interact directly with the seller. Alternatively, buyers and sellers work with a dealer instead of directly with each other. As mentioned, the price of each stock is determined by supply and demand. These calculations are almost always done by computer programs that determine how much people want to buy or sell. Stocks can only be bought or sold through licensed brokers, who use designated market makers. The stock market helps raise funds for companies by selling shares of stock and provides wealth for individual investors. Selling shares raises money on the stock market. Companies offer ownership stakes to investors, which are called shares of stock. Selling stocks on the exchanges that make up the stock market gives companies access to capital so they have more resources for their businesses without borrowing money. In return for giving shareholders a say in how their business runs, companies have to disclose information about themselves and register with regulators. Investors can exchange their money for shares on the stock market. As companies put that money to work growing and expanding their businesses, investors will reap the benefits as their shares of stock become more valuable over time. Investors can also receive dividends from the company's profits, which are distributed proportionally to shareholders. The stock market is a reliable way to grow your money over time, with average annual returns of around 10%. Individual stocks have been found to significantly vary in performance, but taken as a whole, the market has rewarded investors with these kinds of returns. When heard, the terms stock market and stock exchange are nearly interchangeable. However, these are two different words. A stock exchange is a part of a whole. The stock market includes many stock exchanges like the Nasdaq in America. There are a lot of things that people need to take into consideration when talking about the stock market, and it is quite complex. However, even though there are many things that people can refer to as the stock market, they primarily refer to it as being stocks. The Dutch East India Company was the first publicly traded company in Amsterdam. To raise capital, they created a market to trade shares and pay dividends of their shares to investors. In 1611, the Dutch East India Company set up its home exchange. The stock trading activity in the Amsterdam Exchange only involved shares of the Dutch East India Company for many years. Investors excited by the prospect of buying stocks with no downside began investing in any company they could, without investigating the company first. At the same time, countries like France, Austria, and Sweden were also creating companies. This led to financial instability. When investors finally realized that they had spent their money blindly and tried to sell their shares in 1720, there weren't buyers available because of reasons or fear of more companies going under. The South Sea Bubble, another financial scandal in England, followed shortly after the Mississippi Company's collapse. However, as investors became accustomed to trading stocks and the risks associated with investing, they were unconcerned by any future market crashes. Investing in stocks is a common way for individuals to make money. When you buy shares of an investment, you become an investor. The trade of Microsoft happens with another investor. If you want to buy shares of MSFT and hit the buy button through your broker's website, you are buying shares that another investor has decided to sell, not from Microsoft itself. As mentioned, the first stock market was in Amsterdam. America didn't start the game until later. Recently, a group of merchants in Manhattan decided to start their own stock market called the Buttonwood Tree Agreement. It was then that they officially created what we know today as the New York Stock Exchange. Although the Buttonwood traders are considered the investors of the largest stock exchange in America, they were preceded by the Philadelphia Stock Exchange. Founded in 1790, this exchange also influenced the U.S. financial sectors, encouraging their development and expansion westward. In 1971, trading began on a new stock exchange in America. This was the National Association of Securities Dealers Automated Quotations, or NASDAQ. In 1992, it joined forces with the International Stock Exchange based in London. This linkage became the first intercontinental securities market. Investors can buy and sell stocks they already own through an online stock market. As opposed to in-person trading, one can trade stocks over the internet on a computer network. Investors can also buy and sell stocks through the other stock markets, such as that of the American Stock Exchange, or a regional market like that in Boston, Philadelphia, or San Francisco. The New York Stock Exchange was created by traders in 1817. The traders observed and mimicked the Philadelphia Merchants Exchange model to create a new one for themselves. The members of the Board of Trade had to abide by certain dress codes. Members had to invest more money in their seats, which increased from $25 to $100 by 1837. The Great Fire of 1835 largely destroyed Lower Manhattan. Luckily, Samuel Morse opened up a telegraph office. Brokerages were able to maintain communications with this new technology. In 1903, the doors of the NYSE with hundreds of stock certificates held underground in vaults. The stock market surged and reached the high of 50% in 1928, despite indications of an economic downturn. In 1929, the market dropped 11% on Black Thursday, triggering panic in investors and taking all of the 1930s to recover from what is now known as the Great Depression. Since then, the market has experienced several other crashes, notably the subprime mortgage crash in 2008. Years ago, only a few merchants created the New York Stock Exchange and traded a small range of products. But now the NYSE is operated by many parties including investors, exchange executives, companies, and regulators. Dow Jones Industrial Average and the S&P 500 are names you may encounter when reading about the stock market. They are two of the industry's most famous benchmarks that try to capture the performance of the whole market or even the economy. The Dow Jones Index is made up of 30 large US-based stocks. Founded in 1896 by Charles Dow and Edward Jones, the Dow is a weighted average, meaning that the stocks with high share prices have more influence on the index than stocks with low share prices. This index was designed as a proxy for the US economy to see what is happening. Those 12 original components were mainly industrial companies. However, there have been many changes over time. The Dow now includes technology, healthcare, financial, and consumer companies. One original Dow component was General Electric, and it remains in the benchmark today. Meanwhile, Procter & Gamble initially joined the Dow and has been there since 1932. Henry Barnum Poor's Company created the S&P 500 in 1923. Since then, the number of companies listed on the index has increased from 90 companies to 500. Standard & Poor's was founded in 1941 when the company merged with Standard Statistics. Today, the S&P 500 is a market cap weighted index. This means that companies whose market value is larger have more than of an impact on the index. Market cap is calculated by multiplying the share value by the number of shares owned. The S&P 500 has become synonymous among investors with stock market performance and is arguably one of the best gauges in existence today. When people discuss stocks, they often generalize the market to just a stock index. Stock indexes can represent the performance of an entire group of stocks or a specific sector. For example, the S&P 500 tracks 500 of the biggest publicly traded US companies, and it's used as a benchmark to compare their performance with that of other high-performing stocks in a portfolio. The prices of stocks in the market can exchange from day to day. Over the years and weeks, the US has gone through larger market cycles in which the market expands and shrinks. There are 4 stages of a stock market cycle: accumulation, markup, distribution, and the markdown phase. The accumulation phase happens when a market is at a low and buyers begin to snap up stocks at discounted prices. When the price of stocks has been stable for a while, buyers start to jump on the bandwagon, which makes the stock price increase. Throughout this phase, there is a mixed feeling from people due to the fact that prices are increasing, but no one knows whether or not it is just another bubble. In the final stage, prices typically plunge. There are many ways to evaluate what's happening in the economy. However, indexes aren't a full representation of the market. The major stock indexes don't include influential and growing sectors like healthcare, technology, and retail. There are 3 related concepts that are often confused. A stock market is a process of investors buying and selling stocks with one another. A stock exchange is an actual intermediary that connects buyers and sellers, such as the New York Stock Exchange. A stock index is a numerical representation that tracks the collective performance of a group of stocks. Now that you know how the stock market works, let's look at different ways you can invest in it. The majority of people who are retired rely on mutual funds in order to make their money grow, often contained within 401ks or IRAs. Due to the number of investors, these accounts usually have stocks inside them. There are 2 ways you can buy individual stocks. You either need to open a brokerage account through an online broker or a robo-advisor company and have a financial advisor walk you through the account opening process if you want guidance. Some financial advisors will also recommend the best online broker based on your goals and risk tolerance level. When you buy stocks, you'll be using a middleman to purchase them. You'll need to pay fees to your broker or financial advisor, and know that any investment comes with risks. However, investing in stocks can also bring rewards. That's why it's important for you to assess these findings and make a decision for the future. With that, you may have heard that investing in stocks can be a great way to generate wealth. This is true. However, do you now know how the stock market works? Do you know what makes the stock market different from a stock exchange or stock index? Do you know what a stock is? It took centuries to create the stock market that exists today, and exchanges continue to evolve. Investors today can buy shares of companies that are traded on the stock exchanges through a broker. They can also purchase shares of exchange-traded funds that holds bundles of stocks rather than individual company stocks. Knowing how stocks work can help you become a better investor. Understanding why you can buy and sell them at any second or what the market system is will make you more knowledgeable in how it works. The prices of stocks are determined by supply and demand, which is very different than what most people would think. There you have our Fortune Fastlane video for today. Don't forget to subscribe to our channel, click the notification bell, and like this video. If you think we've delivered value, please share this video with one person. Just one share is enough for you to show your appreciation for the commitment and hard work we all put together in creating this video that teaches and helps you on your mission of building your own fortune. And you don't know that one share could go a long way. Keep in mind that no matter how many times you're going to watch this video, you won't see any results unless you take action. Goodbye and see you in the next one.